The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 21st of May, 2021. On the podcast today, Tim Watts, CEO of Shield Therapeutics, provides a US update and confirms they remain on track to launch Accrufer in the US by the end of June. Also on the podcast, Eytan Uliel, Chief Executive Officer of Challenger Energy, explains why they've changed their name from Bahamas Petroleum and gives an update on operational progress. Plus, Paul Hill, full-time investor, equity analyst, gives his view on the market and stocks to watch. We also talk about what does the Indian variant mean for investors and mention the following companies: Sourcebio, Cakebox, Escape Hunt, Gfinity, Granger and Sage. Also, how many times a day should people look at their share prices? And how to stop yourself from buying everything. Plus, at the end of the podcast, I have two lists for you: the top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most read RNSs too. You can check out both these lists at voxmarkets.co.uk. We'll also see lots of other content. In fact, there's a video there by Smiley Paul, N+1 singer, monthly macro update with Jamie Constable. Alba Mineral Resources commences phase 2 underground drilling. And also, I always like this, COVID-19 index. By the way, we talked about Cakebox on the podcast. You can also check out a video Paul did with the guys from Cakebox right there on the front page. Their excellent growth in lockdown. Very good, as we discussed, actually. Biggest riser on the COVID-19 index today is Synergen, up 4% to 104. Biggest faller is Novocyte, down 13.73% to 362. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Tim Watts, CEO of Shield Therapeutics. STX is the ticker there. Tim, thanks for joining me.
Morning, Justin.
Yeah, and you've released a US update, and we'll go into that in a bit and explain what that's about. Before we do, let's take a step back and explain for people not familiar with the company what Shield Therapeutics is all about, if you could, Tim.
Okay, so Shield Therapeutics has developed an oral product for the treatment of iron deficiency. It's approved in Europe, where it's being marketed for us by Norgine. We have a partner in China who's completing the development process, but we decided a few months ago that we were going to launch the product ourselves. We're going to call it Accrufer in the US. And so we raised money in March of this year. We raised £29 million in order to fund the launch of Accrufer. And we think Accrufer has got great potential. At the time of the fundraise, we indicated that by year 3, it could potentially be doing $100 million of sales. Maybe by year 5 or 6, potentially up to $300 or $400 million. So it's a product with great potential, and we're very excited by it.
Cool, excellent. Okay, so you've done this US update, and you say you confirm you're on track to launch Accrufer in the US by the end of June 2021. So take us through why you think that and what's happening there, if you could, Tim.
Yeah, so we wanted to give everybody reassurance that we're still on track. And I guess one of the things that we're trying to convey from this RNS is there is a huge amount of work going on. Before we raised the money, whilst we were able to do quite a lot of thinking about what we wanted to do, we couldn't really do any implementation. And there just is a huge amount of work to do on implementation. I mean, if you take the operational capability, we've set up the legal entity with all the sort of bits and pieces, and HR systems, and so that we can pay people and so on. That's all had to be put in place. IT infrastructure. Recruitment processes, employee handbooks, all that sort of stuff, and that's just the sort of the foundations. Mm-hmm. We are a small company. We started with 4 people in March. We've probably doubled that roughly when we brought some key people in to work in each of the sort of critical areas like market access and marketing and medical affairs and operations. But we've made the pragmatic decision that we simply didn't have enough resources and time to recruit the 30 sales reps that we need in-house. So we made the decision to go to a contract sales organization. That process to recruit the 30 reps is underway, but as you can imagine, just putting in place a contract with a contract sales organization to do that is time consuming as contracts go backwards and forwards. But we've had to put in contracts, and I would think we're somewhere in the region of 20 to 30 legal agreements with distributors, wholesalers, with the contract sales organization, with companies that are helping us with marketing, with the companies that are helping us with medical access. So you can imagine just the amount of sort of legal work that's been going on to put all that in place, and then once we've got those in place, you then have to work on, for example, the materials for training the reps, the materials for marketing, so that the reps have got things that they can take to the doctors, either physically or online. The medical affairs people who will talk to the key opinion leaders, again, they need materials developed that they can use. And all of those materials, the pharmaceuticals industry is heavily regulated. All of those materials have to be reviewed for compliance with the regulations. So there's an extensive process around that as well. And then we've been working on market access. So you have to set a price. We now have set a price, the gross price, or what's known in the US as the wholesaler acquisition cost. We've set that at $500 per pack. Remember, a pack is a month's worth of treatment. So that's now in the public domain. So lots of work going on. How about convey just quite how busy the team in the US are, but we are still keeping to the timetable that we set ourselves, and so we hope that we'll be able to launch by the end of June. There are one or two potential hitches. I mean, in as much because, as I said earlier on, this is a heavily regulated industry. We need consents from states and from the federal bodies, consents and licenses and so on. Most of those we're getting, but there is still the possibility that we get held up a bit by bureaucracy. But I don't think there's any fundamental concerns that have arisen in the last couple of months which would do anything to diminish, if you like, the potential and the opportunity that we have seen for the product. So I guess what we're saying is sort of so far so good, but it's absolutely full on.
Yeah. So you're quite confident it's full on, and I suppose an exciting time, isn't it? Really.
It's very exciting. As I say, we think the product's got some great potential. Iron deficiency around the world and in the US specifically is undertreated. The current therapies, be they oral or intravenous, have their drawbacks, and we think that we think we've got a better oral product. So we do think there's a possibility to both to take the parts of the existing market, but also we've got a product that can help grow the market. So it is exciting.
Yeah, absolutely. Okay then, Tim. As always, if someone's listening right now likes the sound of what you're doing, but are not yet following the story, get them over that line, hit that follow button if they could, get them on the watch list. Give them those 3 reasons if you could.
Okay, well, first I think Accrufer, or Ferrocru as it's known in Europe, is, we think, a great product, and as I've been describing in the US, we think it's got fantastic potential. Secondly, that the launch is coming in the next few weeks, and I guess once we get across the launch line, that is an inflection point. I think more people will start to buy in, which then leads on to my third point, which is we believe right now the company is undervalued compared to what a sort of fundamental economic analysis of the opportunity in the US, but also from Europe and China and other parts of the world can deliver. So I think those would be the 3 reasons I would recommend.
Excellent stuff. Thanks very much, Tim. And like I say, lots going on. So hopefully we'll be catching up in the not too distant future. Thanks very much.
Thanks, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Eytan Uliel, Chief Executive Officer of Challenger Energy. CEG is ticker there. Eytan, thanks for joining us.
Hi, thanks for having me.
Now, some people may think Challenger Energy, it's a new one. I've never heard of that. But, of course, it's you've changed the name today. BPC, of course, Bahamas Petroleum was the old name. And so let's talk about Challenger. For those not familiar with, Bahamas and now you're Challenger, just take us through what you're all about, why the name change and all that, if you could, Eytan.
Okay, well, as you point out, for the last 12 years, the company has existed as Bahamas Petroleum. As the name would suggest, for most of that time, the only asset and the only business of the company was a large oil exploration play in the Bahamas. But middle of last year, so in mid-2020, we embarked on a course to change strategy. So in addition to the assets we had in the Bahamas, we merged with another company, and we also picked up some other exploration licenses. And as a result, the company transformed from being a single asset company to a portfolio company with a broad spectrum of E&P assets ranging from exploration through to appraisal, development and production assets in 4 jurisdictions, loosely speaking, the Atlantic margin or the Caribbean, that being Trinidad and Tobago, Suriname, the Bahamas, the historical legacy of the Bahamas, if you like, and Uruguay. So then earlier in this year, we drilled a large exploration well in the Bahamas. And with that out of the way, the focus of the company has shifted completely. The entire focus of the company for the immediate future is on production, growing our cash flow. And that really will be driven by onshore assets in Trinidad and Tobago and in Suriname. So it's no longer appropriate really to be known as the Bahamas Petroleum Company. The Bahamas is still an important part of our business, but as a more broad-based portfolio company, we thought it would be appropriate to change the name, and that really took effect as of this morning. So as of this morning, we're Challenger Energy.
Yeah, excellent stuff. Okay, and I say there's been a lot happening sort of this week and today. Of course, apart from the name change, you completed a capital raising yesterday, EGM on Monday. Can you give us an update on all these, if you could, Eytan?
Yeah, so as I alluded to earlier in this year, we drilled an exploration well, an offshore exploration well in the Bahamas. That was really the center of all activity, all investor focus. It was a well known as Perseverance 1. It was a well that was drilled safely and without incident. It told us a lot about the geology. We encountered hydrocarbons, but unfortunately, the well was not the commercial discovery we had hoped for. And in the wake of that, as you might imagine, our share price responded quite unfavorably. And we found ourselves in a position where we really had to reset the company. And we, in fact, have called it the corporate reset. And there were a series of elements to that. One element was a shift of focus, a shift of strategic focus, as I mentioned, towards production and cash flow growth. We had and still do have a job to do in terms of simplifying the capital structure. As part of that, we're doing a share consolidation, which will take effect shortly. We also needed to recapitalize the business, and that is what you mentioned happened yesterday. We successfully closed both an open offer and a placing. It was very pleasing. We had strong take-up amongst our shareholders, so it was good to see shareholders supporting the company. We also had strong take-up from new investors. So as part of that, we've also done some work cleaning up the balance sheet. A series of convertible notes got converted into equity. And the final element of what, as I mentioned, is known as the corporate reset is what we're calling the transition. As we go forward, we've made some changes. You mentioned I'm the chief executive. You've jumped the gun by a week. I will become the chief executive on the 27th of the month. And the current chief executive, Simon Potter, will become a non-executive director. A couple of our other non-executive directors have left the board, and we have two new non-executive directors, a gentleman named Stephen Bizzle from Australia, who's a very well-established resource and energy investor and investment banker, and quite a coup to us, a gentleman named Robert Riley, who is formerly the chief executive and chairman of BP in Trinidad and Tobago, which, as I mentioned, is where we will be doing a lot of work in the very near future. So having him on board is a great help to us. And finally, as part of the overall reset, we're doing a complete cost review, top to bottom across the business. We've told everyone our target is to reduce overheads by about 30%. So a lot of things going on, but in very simple terms, all of this is designed to place the business on a completely new footing going forward. You might call it a new start for the company, the opening of a new chapter, and all of this in support of that core strategy, a balanced portfolio of assets spanning exploration through to production, but in the near term, a very, very focused, approach, which really is all centered on production and cash flow growth.
Yeah. Well, got to say at the start there, I did say a new name of the company, new boss there, sort of that company, and new focus, and it looks like it's going to be very busy as well, coming up to approaching drilling time in Trinidad. Can you tell us about that, please, Eytan?
Yeah, so I mean, at the core of everything we're doing right at the moment, obviously, is all of the stuff I've been speaking about is, if you might want to call it, corporate level restructuring, reorganisation. But at the heart of our business is operations. We're an E&P company, and we have a very exciting project in Trinidad. It's called the Saffron Project. In March of last year, an exploration well was drilled there, and that resulted in a discovery. And since then, we've been planning the next well, which is an appraisal well. So an appraisal well is not one that needs to find oil. It needs to establish whether the oil you already know is there can be produced and at what levels you can produce it. So we're ready to go. The well is actually spudding on the 23rd. So that's 2 days from today. The site's there, the rig's on site, all the services are ready to go. It's a 30-day well, so we will know the results of that towards the end of next month. And it has a budget of $3 million. It'll be drilled to about 4,500 feet, primarily targeting both the middle and lower cruise, which are the oil-bearing zones. And the well has been designed in a way that we can immediately put it into production. So this is really the heart of this. If this well produces as we hope, we will see immediate production. We have a P50 estimate in the range of 200 to 300 barrels a day, and from that we immediately start to make some money. Much more importantly, it opens up the development of the whole field. It tells us how to go about developing the field. If it works as we hope, we would look to be drilling more production wells throughout the course of 2021 and then again into next year. And overall, this is a field that ultimately we believe could grow to about 30 producing wells, be producing around 4,000 barrels a day, and that becomes very meaningful. That is an oil field where we would be making north of $20 million a year free cash. So it's super important to the company. All of our attention is on that at the moment, and as I say, the drilling commences in a couple of days from now.
Yeah, absolutely. Marvellous stuff. So there we are. Very exciting, very busy. So one final thing, as always, you know about this, Eytan. 3 reasons, if someone's liking the sound, the progress you're making here, but are not yet following the story, just give them 3 quick reasons why they should hit that follow button on your page and add Challenger Energy to their watch list, please.
Okay, well, I mean, the first one obviously is most of the people listening to this are investors. And at the moment, I believe we represent a pretty attractive investment proposition. So obviously, the share price 6 months ago was different. It was related to what we were doing in the Bahamas. But if you really put aside history, put aside all the baggage, and you look at where this company is today, we have a market value that more or less represents the value of our 5 producing fields in Trinidad, and that's it. And those fields produce oil every day, they generate cash flow, and they support our entire market value. What that really means is that any success we have from here on in, whether it's Saffron, as I was discussing, we don't have time to discuss the full breadth of all the other things we have going on, but any success from here on in represents investment upside. So that's number one. I'd say we're a good value proposition at the moment. Number 2 is you don't have to wait around for very long. Like I said, we have drilling coming up in the next few days. There'll be a result from that in a month. We have more drilling in July in Suriname. We have other things going on. So this is not one of those oil companies where you'll be waiting around for months and years to see results. We have real activity happening right now, and anyone who invests now doesn't have to wait for too long to see what the outcome is. And then the third part is the third reason I'd give is what we were speaking about before. This isn't the same company it was several months ago. It is a new company. It has a new name. It has a cleaned up capital structure, recapitalized, new management, as well as a renewed focus and a refreshed focus. It's very, very simple. We're an oil company. Oil companies need to produce oil. They need to sell that oil, and they need to do so profitably. And for the next immediate future, as I and the rest of the team take this company forward, that's what we're going to be doing, focused, entirely on production that we have, growing that production, adding to that production, and generating cash. And if we can succeed in doing that, then this will be a great company as well as a great investment.
Excellent stuff. Eytan, good to chat to you. And like I said, hopefully, lots going on. Hopefully we'll catch up in the not too distant future. Thank you very much.
Thank you so much for your time. Bye.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast and in full Technicolor, you only get the full glory of Paul Hill, I think, on video. He's a big smiler, equity analyst, full-time investor. You all right, fella?
Yeah, good morning, Justin. It's been a busy last 2 weeks, hasn't it? That's for sure. Crikey, so much news flow. I mean, whether it's basically vaccination programs, people getting lockdowns, Boris, saying people shouldn't go on holiday to amber green, to amber territories. So, packed jam.
Yeah, packed jam. Wow, it's such a jam-packed. You can't get further on. But wait, listen, what do I notice this week, right? Halfway through the week, I noticed that the Indian variant news was slipping down the news agenda. And I thought very quietly, what's going on here? Because at the start of the week, this was going to write off everything. The vaccination program it's gone to hell. Don't worry about that. The Indian variant is going to trash everything. Any bit of work's ever done, Indian variants here. And all of a sudden, got very quiet about Wednesday. So I looked on the BBC site and website, and there was evidence there that the transmissibility of this has been over-egged, pretty much. They said it's 50% more transmittable. Now they're saying it's not. And there's a 50% chance of that happening. Now the PhD looked at the data and said it's a lot less than 50. Now it turns out, AstraZeneca will protect you against it. And this is a case where there's lots of variants. We get this fear-mongering, which is not a bad thing. To a certain extent, it has to remind people, right now, we're still not out of the woods, There's a long way to go, but we're partially the way there. But you have to be careful. And in fact, that, along with the weather, I think, but I've seen some spending figures coming out saying in Wales, retail is booming. But I think it's almost like a slow opening of the economy due to the weather and due to the scariness or the scariant of the Indian variant. I think I don't think yet retail is full up and blooming. It's almost like people can't be bothered to go out because the weather's dreadful and the Indian variant is around. So I don't know what your feelings like, but it doesn't feel like the economy's open yet. I haven't changed my behaviour in a week. Have you?
I sort of have a number of takeaways really from the Indian variant. One, it's been a massive wake-up call for the country and even for the world as much as anything, because obviously, India is one of the world's, and is by far and away the world's biggest vaccine maker, and it's still got obviously all these problems. But for the UK and developed markets, what I think is for an investor's perspective, which is to take away as important, is that even though you might say to people, when you return from the amber and red locations, you've got to self-isolate or quarantine. Frankly, that did not happen when a whole bunch of guys came back from India and then didn't self-isolate. It's carried on working, socialising with their family, and hence we had outbreaks across the country, Bolton in particular. And obviously we've got quite high, vaccination rates. So that's one takeaway. And I think what the important then next step is that the government aren't going to make that same mistake next time. They're not going to allow people to go abroad. and say you can do, unless you've got real, proper reasons. So the holidays, etc., abroad. But if you've got real essential circumstances, you can. But they're not going to allow people to do that, and then they're just that means then we're going to have sort of like a boost on, obviously, more on staycations. But obviously, it's going to wreck those international airlines that rely on that kind of travel, the likes of British Airways, Lufthansa. The low cost will probably be a bit better, because I think there's doing quite a lot of, sort of like point-to-point stuff to Portugal. But that's one sort of takeaway. And then the next takeaway is when it comes to sort of like opening up the economy, yes, sort of the weather's sort of meant that, a lot of restaurants and coffee shops and stuff have been, sort of like... impacted to a certain extent, but I can tell you there's still massive pent-up demand. How many people?
No, there is definitely.
How many people I've seen sitting outside of a coffee shop when it's raining is just enormous, and that just shows you that people want to get out there. So I've got a sneaky suspicion we're going to see a rip-roaring UK domestic economy this second half, largely actually almost triggered by things like the Indian variant, because it's scared people that actually, or scared the government, and they're just not going to allow people to willy-nilly go off internationally until the world has been properly, vaccinated. Because why risk the UK's economy, people's livelihoods, people's health, and all the work and money that's been pumped in? Do you know how much? Did you just read that? How much money the government has put into the economy just to support COVID so far? It's a small figure of £370 billion. They're not going to jeopardise that and allowing a few people to rock off to, places like Mexico and all these other places, India and Southeast Asia.
Do you know what the funny thing is, though? And I know the press are largely a bit scared to talk about this, but if you look at it, I mean, even ironically, even though most of the vaccines in the world are produced in India, their vaccine rate is still below 10%, and I know it's still a big number, but it's still below 10%. It's very transmittable. And then you've got a cultural link to, they've said in Bolton as well, very low compared to the national average. They're saying around 30% of people are vaccinated in Bolton. And of course, we're now over 53% of the entire country. So it's way below national standards. And there's people distrusting of the vaccine in certain cultural sections of society. And that, played into that spread really, and people coming over from India. So, I just think, it's almost like educating people on the vaccine. You've got to have it. Listen, the sooner you have it, because all these scares and it's social media and all that stuff, still flaring up. But it's very interesting. But I think that it's going to take longer. Like you said, we'll always have this, variants popping up left, right, and centre, but as long as sort of protected to a certain extent. But again, there's different. We've said this before. Domestic economy is going to do well because we are far ahead of most countries on vaccinations of programs, and so we don't want to import the virus, unnecessarily.
I think the point is we're always going to get the variants because you'll get to you somehow, even through essential travel. The point is when you fully open up the borders, you're just opening the door and just saying, come on, and we'll get lots of it. Whereas what happens when you effectively have this semi-hard border where you don't allow people to go on leisure and holidays overseas to dangerous areas, when you do that, you give yourself time to prepare and to tweak the vaccines such that you only get a small number of people bringing the variant in. And that's the important bit. And what it also means to a certain extent is we're going to continue to see lots of surge testing. We're still going to continue to see sort of surge vaccinations and surge re-jabbing in September and October for those people who need, protection against the new variants. And that's going to, and another thing which is, sort of perfectly, they took, the UK is now the leader in genomic sequencing of COVID. It's sequencing just about every single positive test in the country. And that's just playing to the book of people like Sourcebio, because they do PCR testing, they do genomic sequencing. The actual backlog and the patient wait listing is getting bigger by the day. And not surprisingly, they announced, because they were one of the leaders in this, they announced last week that well, I think it was on Wednesday, I think, that they're part of that framework contract from the government, from the DHS. There's 15 billion. I mean, just think about it, £15 billion just for one part of that, lot 4. In total, I think it's about 22 billion. And, that the government sees surge testing, PCR testing, and lateral flow testing is going to continue for a long time, because until the world has finally rid itself of COVID, you're always going to get this transmissibility problem, and you're also going to, the variants are going to affect the efficacy of the vaccine. So we either
Did you see that study this week, though? It made me laugh. Apparently, dogs are better at picking up COVID than lateral flow tests. And so you just have a lot of dogs at the airport. It's fine. We have those anyway, drug testing. But by the way, I did do a survey on Monday. Of course, the economy opened up. I did a survey on Twitter saying, will you be going to a bar, restaurant, cinema, or doing something related to leisure or hospitality this week? Started off with the majority of no, people saying no. And then the yes overtook it, 928 votes. And it's like a Brexit vote. It was for a long time. But it was 53.4% said yes, 46.6% said no. So, I'm not sure people understood that was a week. But I'm sure some people. Are you going out this week somewhere? Are you going to a pub or a restaurant?
I don't go out, mate. But my family did last night. Yeah, they were out.
Do you know what? That's true. I just thought this week, my life hasn't changed at all. I mean, it didn't change. It hasn't changed anyway. Whatever. So even if we're in lock, it's pretty much the same. I come to the office and do my stuff, So but
I think say, just finish off that Sourcebio thing. I would add, is that the actual share prices, a lot of these testers are now looking in real value trade. I mean, I was just looking at the Sourcebio shares, and I think they're about the same price as when they listed back in sort of November, about 160. Or about 160. And what that means is that they've got this base business which does obviously all the laboratory testing and stuff. And I think that's worth roughly, sort of around about £2.10 just on its own. And then you've got effectively the COVID infectious disease testing, which I think is frankly going to continue. And if you just model that and just say, okay, we're going to see sort of 25% of, current year's expectations going forward for sort of like levels of, sort of from 2023, about 20 to 30% of where we are for 2021. If you assume that sort of like, this will be over £4 it's worth. So, I mean, I can understand why super smart sort of life science investors, Chris Mills, have been adding to their position, because he can't add much more because he's got over 29%. But,
this is where deep research comes in, because I think some people are maybe lumping Sourcebio in with just a testing company that has, and maybe people are worried about if testing is going to taper off a little bit, they may suffer. But like you say, no, they've got several arms to the business.
Genomic sequencing for them is absolutely flying. No doubt about it. The PCR testing is flying because obviously there's so much surge testing going on. And then this whole screening of cancer and other conditions, biopsies and stuff, we're just pushing that to the right. It's got to happen. And the government's already said that, the budget's not going to be a problem. Now, another thing, here's a question for you, Justin. Over the last 12 months, when you've been in lockdown, how have you celebrated in terms of birthdays and big, anything which is...
Oh, I know this is going.
Have you got yourself a big celebration cake at all?
Do you know what? I was just thinking earlier on, I thought, if this company paid the dividend in cakes, I think they'd get a lot more shareholders. Because and I had, I think maybe a colleague, but a guy from equity investment there, he talked about Cake Box a while back. And I was quite surprised how well they're doing then, actually. And I thought, wow, they obviously they've been affected a little bit, but they haven't been. It's not like the economy's been shut down with them, is it? Really?
Well, when you say affected, I mean, this is the thing you see, because people don't scrimp and scrape when it comes to birthdays during lockdowns.
No, yeah.
And for a business it's a 100% franchise, it's got about 157 stores around the country, I think, which are franchised.
By the way, this is Cake Box Holdings. It's C Box.
It's Cake Box. Yeah, we're talking of which makes basically luxury egg-free celebration cakes. And what we're thinking here is birthday, wedding cakes, and then lots of sort of like bits and pieces where people want to treat themselves on a regular basis, like slices and stuff like that. And it's got a franchise store base of roughly around 157, stores, etc. Now, what's really interesting is that during the lockdown, most retail stores have really struggled. Yeah, they have like-for-like sales for the last 40 weeks up over 14% in the store. That says a number of things to me. Is one, this is a luxury, affordable sort of like, treat that people want, and therefore they're doing it. Their online is absolutely just going through the moon. It is now about 25% of their total sales. And also, the entrepreneurial side of those franchisees is really coming to the fore, because they are absolutely sort of knocking the ball out of the park in terms of, getting the product. And it's been a real game changer. It's shone a spotlight on the company, this pandemic, that, basically has accelerated that whole brand. And going forward, the runway is still massive, because they're still very much underrepresented across the country, certainly in the Northwest and in Scotland, and even really in the sort of the Southwest. And the franchisees make a lot of money out of it. It's got pricing power, and therefore the margins are very good. And I, as a consumer, you look at it and you're sort of like, well, I don't mind paying 50 quid for a lovely cake, which I can guarantee time and again, it's fresh, it's delicious, and it's free from. I mean, if you think about it, I've got, just as an example, I've got my father, he couldn't have his 80th birthday in December when he was actually, so we've delayed it to family do. It's basically down in Reading, not Newbury. I got it wrong when I was interviewing the two guys, the CEO and the CFO. It's down in Reading for August, and there's about we want about 30, 40 slices done, etc. But I absolutely want to guarantee the quality, the freshness, how delicious it is. And some of the guests are, sort of vegetarian. Some of them, they don't want actual egg, and other ones are, not bothered at all. And so when you have a party of a large number, then you've obviously want something which everyone can eat, and therefore, this makes it absolutely perfect. And I don't mind, as long as I can guarantee the quality. And to say the runway ahead, they're going to do, I think, just south of £22 million. Well, that's what they did last year in a COVID-affected year. But I asked the CEO, Sukh Chamdal, and the CFO, Pardip Das, on an interview about 2 weeks ago, how big this business could get to. And they'll be able to do around about 20-25% EBIT margins, which is because it's a franchise model. And that's still less than McDonald's, which is a franchise model, which does over 40%. So there's a lot of runway on that profitability side as they obviously scale up and expand. But I asked them how big that business could get to, given that they're just south of 22. Well, Pardip Das, the CFO, reckoned he could do over 50 million in 5 years' time. And I just ran the numbers on sort of 38 mil at sort of 25% EBIT margins, and I was getting a share price of £4.75 compared to the current one of roughly
that's not big. That's not baked in, Paul, is it?
Very nice. And
I just realised. You talk about birthdays. You're right there. I just realised birthdays. Right. I just 66 million people in the country. Divide that by 365, and you got 180,000 people celebrating birthdays every day. That's exactly a cracking market,
It's a big, and it's underserved because, what you do to get a free from delicious, fresh cake, you can't, you can hardly get them. You have to rock off to get an M&S and get a sort of Colin the Caterpillar, or get a dodgy, jam cream sponge down your local deli. And frankly, you can't rely on the consistency and the product quality, which is really what you want. If you're treating your family, you're more concerned about what your guests like, if they like it, rather than actually yourself. But if you run the numbers using Pardip's and use 50 million instead of my more conservative 38, you get a share price of, I was just running it, you get a share price of over £6. So you've got double-digit sort of capital gains. I mean, the shares the stock has already done really well. It only listed about 3 years ago and has already gone up from, I think it was listing price was 108 to 260, 270 now, which is over 35% per annum return, plus you get a nice dividend. So, I would say to investors, have a good look at this. And if you want to do a bit of lovely due diligence, go and test the product before you buy the shares.
The thing is, you say that
eyes on it and enjoy it.
Yeah, I just did a search there on Google about Cake Box, and the first link that comes up, actually, the domain is eggfreecake.co.uk, which is them. That's their thing.
That's it. That's
very clever. That's very clever, like you said, because you don't want to. If you want to get a cake and you know someone's a vegan, you know, or in fact, one of my son's friends came around on this week, and he's allergic to eggs, and so we have to check everything, you know, all the packaging.
Exactly.
Now, you can't just order from Asda, Sainsbury's, or whatever you're going to get, Tesco, because you have to look on the ingredients and all that stuff and see what it is. If you know they're all egg free, it's a no-brainer, isn't it? So it's a very and that market especially is growing massively. I don't know if you saw Oatly, for example, it's the same kind of thing, but free from, you know, dairy, and it's good for the climate and planet. It went bananas yesterday. Their share price now valued at 13 billion for a dairy-free milk. So that kind of specialist area. So it's going to grow, you know. In fact, a while back, I invested in Agronomics, which is an investment company, Jim Mellon and the guy with Instant Smoothies, now the chairman. But I got bored with it. But I said, this is the way forward. If you can eat meat that tastes like meat, that's as good as meat, you know, cultured meat and all that stuff, and you don't know the difference, but there's no animal killing, there's no less, you know, tiny impact on the environment, and you know, and all that stuff. Why wouldn't you do it? It tastes as good, and if the price is the same, why wouldn't you do it? And so I invested that for a while. Got bored, got out. 3 months later, it went mad. It went up
that seems to be a trait with your investments.
No, the share price went mad, and they just raised 65 million, and I was like, that was a sub sort of 10 or 20 million market cap. They're now worth about 200 million. They just raised 65 million. And so that area, that specialist, you know, free from stuff is very powerful, very big, I think. You know,
well, you raise a really good point, because at the moment, you say that they're egg free, and they do some vegans into the cookies, but they're very close to be doing a sort of like a supercharged vegan celebration cake with all the cream and the sponge and stuff like that. They've managed to get the sponge. Now, this is something which is really important. So I'd advise people to have a look at that video, because you get it. He just comes through perfectly. The CEO, Sut Chadal, and as I say, the CFO, Pardit Das, founded this business back in 2008, 2000. They are still massively passionate about the product quality, about the actual, you know, consistency of it. And so with this vegan product, they're going on to 6th or 7th reiterations, and they're just about to get it. So when they launch this vegan, you know, sort of like celebration cake, it's going to be far and away the best in class, because frankly, it's not easy to make something which tastes delicious and fresh. It's particularly a vegan cream. You just can't even buy it in the shops and stuff like that. So these guys are just into the detail. They're passionate about it. They live and breathe it, and you can just feel the energy when you speak to these guys. And what that means is that when the product does hit the tape, it's going to be first class and significant, a step change on what's available, you know, in the market at the moment. And just to give, and the reason why, you know, that vegan product is so important, just remember, cast your mind back to the headlines 2 or 3 years ago when Greggs launched its vegan sausage roll. It was enormous, and it absolutely jumpstarts even their store estate, and they're rolling out even more vegan. So I actually think it's be a game changer for them.
Yeah, absolutely. I just think, and I think it's literally, if it's on quality, the comparison is exactly the same. If the quality is exactly the same, and the price point is wrong, in fact, people are prepared to pay a little premium if you avoid it. If you're avoiding sort of anything that this, and let's be honest, agriculture is a huge, you know, climate. It has a huge impact on climate, livestock agriculture, massive. You know, the water consumption, land consumption, everything. Now, if you're eating a cake, for example, that has less problems with it's less impactful on the environment. It tastes as good. The price point is around the same. Don't mind paying a little bit premium. It's a no-brainer. Most people don't want dead animals. They don't want to kill an animal, you know, but they love chicken and they love steak. If you get the same tasting steak or chicken for around about the same price, but it doesn't involve killing animals, you do it. It's a no-brainer. Same with cakes, you know. You'd go, as long as it tastes good, and like I said, the price point is around about the same, a little bit of a premium maybe. I think it's a no-brainer, you know, absolutely.
Yeah, I mean, I think it's more to me, you know, as a consumer. It's if you have a big family and friends gathering, let's say a wedding,
as well.
All you're doing basically is you're more concerned about how people are going to think about the products when they taste it at the do, and you don't mind paying 50 quid, 100 quid. If it was a big wedding cake, you pay 200-300 quid, just almost like as insurance, because you're making sure it's absolutely sort of top notch. So
but before, I mean, if you look at going back years ago, if you had a cater for a big party, you probably have like one person that is say 50, who maybe is a vegan or vegetarian. These days, you probably get 10% of people now saying we don't eat that. So you've got to cater for that because it's a bigger slice of the pie.
It's a lifestyle. Rather than actually a food intolerance, it's a lifestyle, isn't it? You know, they basically want to save the environment for environment. You know, for environment.
Have you done that? I mean, I've got cut down massively on meat in the last 3-4 years, and I hardly eat any meat. You know, and
what have you been doing? Moving on, what have you been doing in your portfolio over there? You've been sort of like chopping and changing, getting bored.
No. I haven't. I literally, I'm still holding the same stuff. You know, I mean,
what do you own, by the way? What's your 6 core holdings? I know you mentioned it last time.
Let's have a look. I'll tell you the ones. Listen, I can't reveal some of them because I haven't revealed the club. But my core,
only the ones you.
I mentioned at the moment. My core ones are Polarian, Gfinity, Escapant, Truefin. You know, there's my 4. And you know, Escaping had finals out this week, which is quite funny because I saw someone on I think it was Stockopedia saying, "Oh, this company since IPO." I think you can't judge a company of like 3 years ago where they are now. It's like because I always said Escaping have always said we're not going to be in it EBITDA positive until we get to sort of 15, 16, 17 sites, and that was always the case. So people investing at the IPO must have been aware they have to raise more money here, because they're not going to be generating cash. That's a basic, you know, that's when I'm looking at researching small caps. I'll always look for that line in the sand where are they going to be profitable soon? Because I like that transition from them becoming loss making with the sentiments down a little bit because they've been burning cash for a while maybe, and all of a sudden there's a line in the sand that we're going to be sort of profitable next year. And that thing, you know, it's a value inflection point. I quite like that. And that's happened with Escape Fund, happened with Gfinity. And in fact, Gfinity have news out today that, do you know, are you aware of Future? The media company.
Yeah, Gfinity,
John Clark. Yeah, well, Gfinity, John Clark, when he came on the podcast, he took over from even the new CEO, and he said, "I'm cutting costs. I'm going for higher margin business like media and stuff we own, and not so much just servicing other people with esports solutions that, you know, the margins are very thin. So I'll still do that, but be very choosy over it." And his model at the time was Future, and I didn't really know much about Future. And he said, "Have a look at the Future. That's the kind of model I want to go for, you know." And in fact, they've just taken on a non-exec director who used to be with Future. And they've also got 2 Apple executives, senior Apple executives on board as well with Gfinity. And they're heading in the right direction. The margins went from like, it's something like at the time, the old board they had on there, the margins was something like 12%. And he's sitting up at 60% plus, gross margin there. So he's getting there. He said he's going to be profitable. And so he's getting there slowly. There's warrants.
Well, it just sounds as though you've got some rock star directors there from the corporate world. So you get
and
that sort of brain power and networking effect.
Yeah, and they've taken options, and it's not a huge amount. You don't pay huge pays. It's quite like that. Escaping though, for example, I mean, there's always be careful. You always should read final results. But if you don't know a company and what they're doing, then the final results are out of date and they're irrelevant as a story. You can obviously look at, there's a lot of information in there, but you can't judge a company on its final results that were, first of all, were 6 months ago at least. And secondly, we're in a pandemic. And so Escaping, of course, they're not going to do well financially when all their sites are shut down for the majority of the year. But even so, the EBITDA loss went down from 1.7 to 1.4, helped by some COVID stuff. But also, like-for-like sales, when they're open, went up by 25%. And in fact, in the more mature stores, went up by 44% and 59% over certain timeframes. And they've expanded from 8 sites to 18 sites, and in fact 19 sites. They're doing lockdown. So I think that is a mark of and also launched new products. That's a mark of a company that's pivoted very well. And I don't know any leisure company that's gone from expanding massively in a lockdown and also have 3.3 million cash. So I think they've done marvelously, and now they've opened back up, which is nice.
I know one. It's called Cake Box. All I would say is actually they're not that dissimilar, because I think they'll both do really well. As international travel is not really good.
I mean, the thing about Cake Box is
they'll both do really well.
Yeah, the thing about Cake Box is luckily luckily they've got an online thing that can be shipped, and Escaping didn't have that. During lockdown, this happened, they had nothing. They had nothing but physical sites, and so they had to pivot. And I think
there's a lot of similarities, because it's non-discretionary. People want to enjoy themselves and prepared to pay a decent price.
They've got a franchise model as well, which they're going to be.
Well, there you go. It's amazing, isn't it? Absolutely.
There's ambition there to
the other thing which is really hitting the tape at the moment is M&A. And we had KKR this week buying out infrastructure owner John Lang for about £2 billion. We also had a couple of weeks ago Blackstone, the other big sort of infrastructure VC, buying St Modwin, and that was agreed last week. And I only point that out because there's lots of other things like Proactis we talked about. Immunodiagnostics was also taken out by another US company. But I own, as I mentioned before, the UK's largest private rental sector landlord called Granger. And I think they're right in the crosshairs as well because, their share price is roughly around about net assets. And frankly, they're seeing a lot of people now go back into the cities, young professionals, to actually go onto their buy-to-rent properties in places like Birmingham, Manchester and London. And I could see just one of these big infrastructure, guys just knocking on the door and picking them up at not a massive premium, but sort of 30% premium. If make a perfect fit for them, why not? You get the biggest landlord in one shot. It's effectively a trophy asset that you're never going to get again. So I would mention that one. And the other one, which I do also own, that I know investors have asked me to update them on, is Sage, and they came out with some pretty encouraging interim results about 2 weeks ago or a week ago or something like that. And what was really sort of caught my eye is that last year, 5 of those 6 months was pre-pandemic, and they had really strong numbers, and they still managed to beat it on a like-for-like basis. Organic sales are about 1%, but the effectively recurring revenues are at 4%, and most of it's actually recurring revenue. So they're really heading in the right direction, and their shares are ticking up nicely. They're sort of like roughly around about, I think they're around about £6.50 now. So they're moving up. They'll get bought out. I'm absolutely convinced they will. And the other thing, which is a good read across, we've talked about it before here, and I know investors have sort of flagged it and stuff, but small businesses are digitizing left, right, and centre. And we've only just really sort of like, at the tip of the iceberg. They're seeing it, Sage. We've got Alico or AlicoSoft, as another one. That was then when they reported they're seeing their clients digitise heavily now as people return to the office, and also Equals. They're another beneficiary of this whole digitisation, online payments, and international forex and stuff like that, because it's straight through processing at the touch of a button, makes it much easier. So, and that's really going to across the whole of the software space. If you're looking at a software provider that does back office systems rather than your Zooms and your Teams and those sort of like, teleworking type of stuff, then they're absolutely flying. So, I think those companies are going to do really well over the next 2 or 3 years as small, medium-sized businesses catch up with their bigger cousins by digitising the whole of their businesses.
Let me ask you a question. How often do you check your share prices?
Well, it all depends on how busy I am, but I usually check them at least once a day.
Once a day? I don't check mine once an hour at least.
Oh, okay. It depends on whether what you're doing and whether
that's
you're
not, I'm saying I wish I could do once a day. I did a survey just recently, how often you check your share prices, and I think, like I said, if you can get into the mind frame of you're buying a business, then like Buffett, he doesn't care about share prices for a certain extent. It's the value of the business and how much value that will generate. And I think shares are too liquid sometimes, and some people can trade them. You can check the share price all the time, and the thing is, sometimes you think about the share price, not the business. And I wish I could. It's too easy, isn't it? It's too easy to check your share prices. It's too easy to buy and sell shares, and that's the problem. Sometimes you forget there's a business there. You just look at the share price, and that's a
good discipline. Yeah, if you want to get into an owning business, is think what the value is of the business.
Yeah,
and that's where you need to work out the intrinsic worth. If you work out what the value is, then the shares are immaterial, how it moves on the day, etc. And that's the key bit. When you get news, has the value of that business moved up or has it moved down? And that's really sort of the sense check, because your daily movement to the share price, yes, if you're going to sell might be useful, or if you're going to buy might be useful, but most people are not buying and selling on a daily basis, they're holding, and therefore concentrate on the value of the business rather than the price, which obviously can go anywhere to a certain extent.
Yeah, well, I looked at a video recently. If you look at a company, you should look at 3 things there, essentially. And that's look at the valuation as is, that the market's given it at the moment. Try and work out.
No, that's the price. That's the price.
No, I know. What I'm saying is try and work out the value of it.
Yes.
And then try and work out the value generation it's going to generate over the next 3-5 years, and that's where you should be. So so what I'm saying is, is the price, yes, but what I'm saying is what is. I'm talking about enterprise value or something like that. But look at that, and then try and determine if that's a good valuation, and see if you can work out how much generation value is going to do in the next few years. And then when you start doing that and look at it in a business rather than just look at the share price, you won't be swayed by, because when you start off, people who are under research or don't know how to research get scared out get worried out of a good investment just because the share price has gone down. Don't get worried out by something. If the business is improving, you shouldn't get worried, because what the price of the business is doing can be completely unrelated. Most of the time it is. Out of step with the video. I know.
The key thing, the sort of like the the trigger for investors, or the thing to really sort of like concentrate on with the price, is that, let's just say, for instance, you've got 100 million shares in a company, in company A, for instance. Typically, less than 100,000 or 200,000 of that 100 million of shares. So we're only talking sort of like, well less than 1%, perhaps less than 0.5%, trade each day. So what we're saying is that the ownership structure from day one to day two hasn't changed. And therefore, all you've changed is just a few small people in total game scale of things, buying and selling. It isn't what the business is worth and what people who own it long term believe it's worth. It's just a few shares going through the market. And that's the key. When it's that classic sort of is that saying from Benjamin Graham. In the short term, the stock market is a voting machine. In the long term, i.e., such that it's driven by sentiment and price, or price is driven by sentiment.
Popularity.
In the long term, it's a weighing machine where it's driven by earnings.
So, marvelous stuff. Anything else you want to chat about, Paul?
No, that's good. You got anything on the crosshairs at all to tell me in 2 weeks' time? You got on holiday soon?
Yeah, no, I've gone on holidays, yes, but I've got it. I have to whenever I invest in a company, I want to do a video because it helps me. And I think sometimes, like I said, when you're looking at companies, by the way, how can you? I find this very intriguing. If you're looking at a company and researching a company, you really like it, because you've done this quite often and you've been quite enthusiastic about it. How can you stop yourself buying it? Because there must be companies you've seen there thinking, because that's a problem with in my Share Pickers Investment Club. I've told people, don't buy every opportunity out there, because there's plenty of opportunities. You've got to go in bigger on the ones you have massive conviction on and convinced on, because it's like buses. One will come along every sort of 5-10 minutes. You can't keep putting a little bit of money here, there. So when you see a company that you think is a perler, you think, wow, how do you stop yourself buying it? You just look at the one companies you have.
If I think it's a high conviction play, I usually push the button, to be perfectly honest. If I have cash, unfortunately at the moment I'm fully loaded in stocks, so I haven't actually got much spare cash, so I do push the button. But I say I'm very selective. I like, there's lots of stocks. But
you wouldn't, for example, put a 1% of your portfolio value in a company. You'd have to be a big high conviction play. No,
exactly. And also, given, I'm looking at a 5 to 10% of my portfolio, I jump into stocks or put into stocks, then frankly, anything which is not liquid enough, it just isn't going to happen. I just can't get that type of volume through. So, that's another limiter on it. But there's lots of stocks that I would like to buy at the moment, but I haven't got the money, as like spare cash. But it'll come. If they get, I think there's a lot of them who could get taken out. The key is if you are impulsive, it's to recognise you are impulsive and to stop yourself buying 125 stocks, because you're never going to look after it, and your hit rate's going to go down, and you're never going to be able to really, move the dial. So that's the sort of key. And if you really want to sort of like something, go and have a cold bath. That'll stop you.
You mentioned cold baths a lot. Do you do that a lot? I bet you go swimming in reservoirs. So, that's a similar thing. That's there we are. If you're going to buy, if you're an impulsive buyer, just go for a swim with Paul in the reservoir, and that'll sort you out. By the way, if you're a fan of video, which I know you're, Paul, I'm doing a weekend podcast I normally do with a few mates. They're coming down. First time ever we've met for now for over a year. we've got together, and so we used to do them sort of once a quarter. Used to come down to my house. We used to film a weekend podcast live, so we're doing that now tomorrow, which is quite nice. They're coming down, we're all getting together in the summer house. Luckily, the guys who I'm with, like Steve, is into it's his job, is video and audio, so we can do a good production job on it. And so we're doing that tomorrow, and in fact, it's a cracking debate I've got. I've got a question for tomorrow. I know people will get into, but I'm not going to say it now. But it's something I know investors will be passionate about. But if you got a few spare minutes, Paul, get involved, fella.
I will do. Yeah, look forward to it.
All right. Speak next week, fella.
Cheers, Justin. Have a great
maybe the week
weekend.
after. Yeah, cheers, buddy. Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Blue Star Capital, non-mover, 0.17. At 4, Vietnam Holding, non-mover, 232. At 3, Shield Therapeutics, Tim's on the podcast, of course, up close to 5% at 60.5. At 2, Omega Holdings, down 30%. Wow, what happened there? To 16.45. And at 1, Mobile Streams up 3.7% to 0.28 pence. Okay, it's time for the top 5 most read RNSs. They are as follows. At 5, Gfinity, and that's a non-executive director board appointment. Of course, in fact, it comes from Future, which is the company John, the CEO of Gfinity, models Gfinity on, actually. So it's good help there. And of course, they've also got 2 senior Apple executives. At 4, Shield Therapeutics, US update. Tim's on the podcast. At 3, official list restoration, Omega Holdings, 545. At 2, Tizion Life Sciences, director PDMR dealing. And at 1, Novocyte, DHSC dispute update. That's it for the podcast. Thanks for listening. In fact, the most liked there is Gfinity NED board appointment. That's it for the podcast. Thanks for listening. Muchos appreciate.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.